Again, listening or not listening, bond markets have a way of determining economic reality in very real ways, particularly as you look at the cost of government borrowing. And so the current forecast call for U.S. deficit spending at 6 to 7% of GDP. That is unheard of outside of wartime or outside of a time of crisis, which is clearly not where we are, with very low levels of unemployment and very reasonable levels of economic growth.
You know, we talk about the bond market as this amorphous thing, but, you know, people are trying to, I guess, humanize it more because the whole term bond market vigilante is coming back, right?
Sure.
What do you think of that? Because, you know, when applied to emerging markets, right, which are much smaller and much less liquid, et cetera, easy case to state, it is probably real. You know, just take a couple of hedge funds, right? In the case of the U.S., though, the Treasury market, maybe not. Certainly a couple of traders, or a lot of them, but bond vigilantes, really?
It is the biggest, most liquid market in the world if you look at the market for U.S. Treasuries. One thing that we're focused on at J.P. Morgan, though, is the changing composition of that market. And on our analysis, you're moving away from, quote, price-insensitive buyers, so think sovereign governments, inclusive of China historically, into more price-sensitive, yield-seeking investors. You're doing that at the exact same moment in time that the U.S. is forced to lengthen the duration of their bond holdings away from T-bills and towards bonds. And this is something that the incoming Treasury sector, or the potential incoming Treasury secretary, has talked about in detail. That lengthening of duration requires buyers on the other side of the pad. And you're looking at $2.1 trillion in issuance over the course of the next couple of months. And so these aren't small numbers. And so the ability for this market to really start to assert control on the cost of money, the cost of borrowing, the cost of funding these deficits is very meaningful.
So, which leads to the next question, right? And the whole issue of a buyer's strike and also the indirect bid, right? Where do you think China's going to end up on this? Because, I mean, look, we've talked about it in the past, and it is a red herring. China could threaten, right, to either slow or stop buying U.S. Treasuries. Really? That's going to hurt their own portfolio, right?
It does. And look, I think one of the most fascinating geopolitical conversations, again, that we're having with clients at this stage comes back to the perception of a coming negotiation between the U.S. administration and the Chinese administration. And what I think is very unclear, and based on our conversations with governments on both sides, it's clear that the Trump administration is coming in looking at tariffs as a potential negotiating tool, as well as a potential revenue generation mechanism, which we can talk about in more detail because there's some interesting numbers there. If it is a negotiating tool, then the fundamental question is, what does the U.S. administration want? What are they trying to use this to achieve? And that is an extremely opaque conversation right now on both sides of the divide.
So it's not just wanting to sell more soybeans to China, right?
No, and then look, at the end of the day, that was Trump 1.0, and China actually didn't. There's some $200 billion of incremental agricultural goods that they have yet to buy. And so that's probably not the attractive component. The one thing that we're trying to wrap our heads around analytically, and the one thing that China could very clearly step in to do, because you could argue that it's in their own macroeconomic interests as well as potentially in the U.S., is inbound Chinese FDI into the United States. It's very unclear if that's politically acceptable in the U.S. right now, but that is something that could potentially be put on the table. That's very similar to what we saw if you go back in time to when Japan was the trade problem for the United States.